The pandemic has, as you can imagine, made the markets even more unpredictable. We've gone from severe lows to record highs. First Financial's Kurt Copenhaver talked about what to look for going forward with Courier Market Engagement Director Kelly Snyder.
Thanks so much, Kyla. And Kirk, thank you for being here. It's been a little while since you've been here, and I just wondered if you could tell us what's been happening in the market since we last talked.
Yeah, I mean, it's been a wild ride this year. We had that huge sell-off in the first quarter, and then the second quarter was the best quarter the S&P 500's had in over 20 years. And I think the main driver for that, as I think talked about last time, is improving sentiment, both in terms of, investors feeling optimistic about how the economy is going to come out of this, and also the ability to develop medications and stuff and the impact of social distancing to control the pandemic and the damage that COVID-19 is going to cause. One thing that sticks out to us right now as a potential risk is that the market's getting a little top heavy. There's 6 stocks: Facebook, Amazon, Apple, Microsoft, Netflix, Google. Those 6 stocks represent about 25% of the S&P 500. And if those 6 start to struggle, that's enough of an influence to hold the entire market back. And historically, when the market does get this top heavy, it tends to do that. It tends to kind of self-correct. So we think that's a reason the market might be due for a breather here.
So why else do you think the market could go sideways here?
Well, I mean, valuation is a risk. Price earnings multiples on an absolute basis are very high. There's no arguing that. And I think a lot of that reflects investor expectations that this is going to be a pretty smooth recovery on the earnings front. But if that earnings recovery takes a little bit longer than expected, those PE multiples could contract. We're set up to have a big year-over-year decline in earnings. Because of the shutdown, earnings are going to decline, 18, 20%, somewhere in that range. And usually when we have a big hit to earnings like that, it takes a while to get back to those prior peak levels. With the second quarter earnings releases just now starting up, we're getting our first glimpse into what corporate management teams are looking at for the rest of this year and into 2021. So that could be very telling in terms of what the market does going forward. The economic recovery could take longer than expected as well. In a real simple view, GDP growth could be boiled down to growth in employees and then any kind of productivity growth. Add those two together, you get an estimate of GDP growth. It's key to remember, we lost 15% of the jobs in this country during that shutdown. So unless there's a productivity boom, like we're talking, which we think is unlikely because productivity has been increasing 1.5%, 2% for the last several years, it's going to take some time to get back to that prior peak level of GDP. Just for reference sake, in the financial crisis, we lost 6% of our country's jobs and took 76 months to get those back. So economic recovery could take a little bit longer than expected.
So based on all of that, how are you positioning your client portfolios?
Well, right now we're not getting super bullish or super bearish. Like I said, valuations and earnings, that's a risk. And so you don't want to get super bullish on equities. But at the same time, interest rates are so low, it's hard to get super bullish on bonds either. So it's kind of that old Tina thesis playing out. There is no alternative to investing in stocks right now. So net, again, we're not super bullish, we're not super bearish, we're kind of neutral. Within equities, we are slightly overweight to the U.S. large cap space, as well as emerging market equities. Within fixed income, we're slightly overweight to those. We're emphasizing that those credit sensitive areas of the market relative to those areas that trade strictly on what interest rates are doing. And then lastly, within the alternative space, we're focusing mostly on things that would protect our client portfolios in case market volatility flares up.